Toronto, Canada, who would come out ahead? A renter who buys and holds Bitcoin for the next 20 years, able to buy $300,000 worth of Bitcoin, which is a lot of Bitcoin these days. You would be way somewhere like 16 coiner at that stage, which is huge. And a homeowner buying $1 million property with 20% down and paying all the expenses, etc. And you'd be able to spend $100,000 on Bitcoin because 20% goes into your down payment on your $1 million home. Interesting story. So I thought about doing this a number of different ways, getting real complex with a P&L and estimating property taxes and water and garbage and painting and depreciation and upkeep. It got too complex. I just don't know the Toronto market well enough. So I decided to do it just broad brush. But if I did have all those parameters, I can definitely do it because I got the model built. But here, let's look at Toronto real estate. Over the past 25 years, it has gone up 453%. So assuming that continues, the Toronto real estate is as a CAGR, compound annual growth rate of 7.08%. I could be wrong by 0.01%, but that's the CAGR over the last 25 years. Now, this is part of the problem. This is the money printing story, and this has an impact on all assets. The more money in supply, the more everything inflates upwards in terms of price, and of course, things debase, and we're living through that right now. And here you can see how the Canadian money supply has grown from about 11 or 116, whatever that factor is. It's gone up 220, 225% just in the past 10 years, which is staggering, but very similar to the US, very similar to Europe. Everybody's printing like crazy. And by the way, there's another question coming towards the end of this presentation where I'll talk more about the impact of that money printing too. So let's talk about this. This is the model with $1 million home, 7.08% compound annual growth rate, and expectations for Bitcoin over the same time. And then we'll see how these things map out. And again, I've used this model a number of times, but here you've got the year 2023. The house is $1 million. The money printing expansion rate is assumed 15%, and that will accelerate by 8%. And I assume that purchasing power debasement will be 60% of that money printing expansion. And if you look at your $1 million home, in real purchasing power, you can see because of the debasement, it'll go down in value, but it will also appreciate by 7.08%. So the third column on the right is the one, the orange one I want you to focus on. That $1 million home is $1 million home in 2023. But in 2024, the real value after debasement is $910,000. The nominal value is $1.07 million. But your home valued in real purchasing power terms would be about $974,000. So over the next, I went up to 2039, but really, you can really go at just 10 years. You can see your house will be worth $771,000 in real purchasing power, or nearly $2 million in Canadian dollars. But the question is, where does the Canadian dollar go? How strong will oil and other resources have on the economy? All of these are unknowns. Will the government continue to print? I know some of the new politicians want to stop this money printing stuff, but we'll see. Now, in terms of Bitcoin, here, if we take 1/6 of historic appreciation, 66%, and then ratchet it down after the year 2028, you can see that the Bitcoin price could jump quite a bit. Many people believe 2023, 2024, assuming we get back close to an all-time high again. You can ratchet this either way. We could get to getting out to 2035, 3.7 million, which is worth $1.4 million versus your real value of your house of $771,000. But the key factor is what you have is 20% down on an asset, and that means things can scale up. So what I would do in this case, I would buy the castle. Me, not you, not advice. I would buy the castle with 20% down, and with the balance, I'd put 50,000 into Bitcoin and 50,000 into Tesla, just in case Bitcoin blows up. Just in case Tesla blows up. The odds of both of them blowing up are very small, but we always have to be prepared for that risk as we go forward. But your house will not blow up, and even if it does, it's probably going to be well insured, so you're going to be fine. And that's what I would do, because you are going to just be putting $200,000 in a house that will become, if you're paying off your mortgage over that 20-year period, will become a very valuable asset that you need to live in anyway. And that's very, very important. I can't stress that enough. Everybody needs to have their own castle. So that is kind of the rough answer. If I had more data, I get more sophisticated modeling this out.